When we analyze wealth disparities, the conversation often focuses on income levels, but income alone does not explain long-term financial outcomes. Many individuals with high incomes still struggle financially, while others with moderate incomes quietly build substantial wealth. The difference often lies in behavior. Research in behavioral finance and economic psychology shows that repeated financial decisions, compounded over time, create dramatically different results. Here are 7 behavioral patterns that frequently separate low wealth outcomes from high wealth outcomes. First, reliance on earned income alone. Many people depend entirely on wages or salary. This creates a direct trade of time for money. If they stop working, the income stops. Higher wealth individuals prioritize acquiring assets. Assets such as businesses, investments, intellectual property, and equity generate income independent of daily labor. The goal shifts from earning more hours to owning more systems. Second, reactive spending instead of intentional allocation. A common pattern is spending first and saving what remains. The issue is that there is rarely anything left. Wealth builders reverse this structure. They automate investing, contribute consistently to long-term accounts, and treat savings as a fixed obligation rather than an optional activity. This structural difference alone can change financial trajectories. Third, limited financial literacy. Numerous studies show a positive relationship between financial knowledge and wealth accumulation. Understanding compound growth, inflation, taxation, and risk diversification dramatically improves decision-making. High-wealth individuals often dedicate time to studying markets, business strategy, and capital allocation. Financial education becomes continuous rather than occasional. Fourth, risk avoidance without evaluation. Avoiding all risk may feel responsible, but it often limits opportunity. Every meaningful financial gain involves uncertainty. Wealthy individuals do not seek reckless risk. Instead, they assess probability, potential downside, time horizon, and expected return. They make calculated decisions where the long-term upside outweighs the short-term discomfort. Fifth, consumption-driven identity. In many cases, spending is used to signal success. Cars, clothing, and lifestyle upgrades can create the appearance of wealth while reducing the capital available for investment. Wealth builders prioritize ownership over appearance. They allocate surplus capital toward appreciating or income-producing assets before upgrading lifestyle. Sixth, an external locus of control. When individuals attribute outcomes solely to the economy, their background, or other external forces, proactive behavior declines. While structural challenges certainly exist, wealth accumulation is strongly correlated with personal accountability and strategic adaptation. High-wealth individuals consistently ask, what can be optimized, learned, or adjusted within their control? Seventh, short-term orientation. Modern culture rewards immediate gratification. However, compounding requires time. Whether in investing, business, or skill development, exponential growth emerges from consistency across decades. High-wealth individuals make decisions based on long-term positioning rather than short-term emotional reactions. It is important to recognize that systemic factors and unequal opportunities are real. However, within any environment, behavioral patterns still influence outcomes. Wealth is rarely accidental. It is the cumulative result of disciplined decisions repeated over long periods of time. When habits shift, results follow. Financial transformation is less about a single breakthrough and more about sustained behavioral change.